Hi, everyone. How are we doing today? We are the real estate ladies of North Atlanta, Mary Ellen Vanaken, Susan Jennings, and we have a special guest today, Mr. Marc Budnik from AmerisBank. So we're going to be talking all about lending today. So Marc, how are you doing today?
I am absolutely amazing. I'm very excited because the market is booming. Rates just recently dropped, which is phenomenal. And the Feds have been talking about another rate drop, and the official rate drop this coming September. So I'm very excited about the final momentum and being able to help happy people become homeowners.
Fantastic. So just tell us a little bit about you and how long you've been in the business and what's a great client for you and just kind of how you do business.
I kind of fell into business. A long time ago, I wanted to be a juvenile probation officer. So I came down here from Connecticut to become a probation officer because when I was growing up, I was picked on a lot. And if it wasn't for my family and support, my friends, I probably would be in a different place. So I really wanted to be a great mentor for kids. And so probation, juvenile probation was really my calling. And so when I got down to Atlanta, Georgia, unfortunately at 23, I was kind of naive and I didn't do a lot of research. And I found out the level 2 position was paying about $19,500. And at that point, I pretty much was running out of money. I came to Atlanta with about $700 to my name. A friend of a friend said to me that, you have a really great personality in sales and you should get yourself involved in, some type of sales. And, I didn't really understand that because I was brought up from my parents said, if you went to school for this, then you had to go ahead and go into this type of career. But since I was broke, I was really just open for everything. And he put me in contact with a construction company. And what they did was they ran 90 miles around metropolitan Atlanta. And I would go into people's houses and I'd talk about different types of sunrooms and decks and windows and kitchens. And at the end, it came down to financing. And what was really interesting about it is once I actually started the job and I found myself into houses, I had this light bulb go off. I'm like, oh my God, I wanted to be a juvenile probation officer to make an impact. But now I'm with the husband and the wife and the grandparents and the friends that are stopping over and the neighbors and the kids. And it just really put me into a wonderful position that I can still make an impact doing this. And just through, building relationships and really caring a lot about people and trying to give and provide and serve to everybody I can, I basically dropped off the contracting part of it and really focused on finances and really advising and guiding people to financial freedom and investing into homes. So that's how I fell into the industry.
That's awesome. That's awesome. Yeah, that's great. And you are local. You work for AmerisBank. So tell us a little bit about why you work with them and what kind of what do you like about this? You've been with, obviously a couple different mortgage brokers in your career. Why Ameris and what have you found with them?
So AmerisBank used to be Fidelity Investments. We still are, but Ameris came over and they took over the mortgage and the banking division, and they just made that area of it a lot more effective and efficient when we're providing services. I wanted to work for a bank because everybody feels a lot more comfortable with the bank, and being that we do service loans and we are able to really give everything we can to our clientele, it put me into a very secure position. One of the reasons why I really loved AmerisBank is because I technically am not a banker. So I work with a bank, but I don't work at the bank. So I work with the bank, but I don't work at the bank. So I'm not the type of person that you can go ahead and give a checking and savings account to. My special division is mortgage. And so I've been very blessed to run a performance team out of Alpharetta. We're actually located at the Avalon. And I have my own underwriter. I have my own closer, my own appraiser, processor, loan coordinator, loan specialist. So as a team lead, and when you actually have full control of the whole entire process, it just takes this level of stress and pressure and overwhelmness completely off the clientele, the people who we're working with. So it just allowed me to really keep things very streamlined, and it makes me feel really good because there's never going to be a time that when we're going through a mortgage process or an application that I can't communicate with all parties, just to make everybody a lot easier. So, working with the bank is also another perk and a benefit is our interest rates are extremely aggressive and some of the best in the market. And I just love to be able to provide very aggressive rates because people are very conscientious nowadays in how their money is being spent and what they're doing with it. And, one of the other attributes I really fell into is we don't really follow by bank guidelines. Even though we do, We offer a lot of different products. There's actually not one type of product that I can't provide our clientele. So we do bank statement loans and construction of perm loans, and we do land loans, and we do all different types of unique portfolio loans, as well as the normal conforming loans for 15-year, 20, 30-year fixed mortgages. So having that diversity really makes me a tremendous asset, so I can really help every single person I come in contact with.
That's fantastic, because it really, who you work with matters. So, and in being in the real estate and doing business with many different lenders on the buy and sell side, we see all kinds of things, but you have it all. You have it all in-house. You have any issues or any problems, you can jump and you can close loans faster than anybody I know. So that's what's good to know too, which is great. So Sue, why don't we dig into more of the technical stuff that we're going to talk about today?
Right. Well, I wanted to ask Marc if he could explain for our listeners who might not be as familiar with all of this as Marc is, or we are, because we do this every day for a living. If he could, in very, straightforward terms, explain to our listeners what makes something a conventional loan versus when, an FHA loan is used, based upon somebody's, particular credit criteria and so forth, versus a VA loan.
So that's a great question, Sue. Those are three different types of programs. So you have conventional, you have FHA, which stands for Federal Housing Authority, and you also have a VA loan. So VA, straightforward, is going to be for servicemen or women. A lot of folks, for what I feel is an amazing loan, because people who are servicemen or women are very militant, because that's how they're brought up when they're in the military. So you're dealing with a lot of people with really great credit scores. And so what the benefits of the veterans has actually been provided is that the down payment is actually zero for a VA loan. So if you're a veteran, you do not have to put down any money to obtain a home mortgage, which is really great. With VA loans, there is some type of fee that is being collected as well. Nothing is really free in life, but the veterans who have been disabled, they have the ability to waive what is called a funding fee. So Veteran Affairs, what they do is they charge the servicemen and women a particular fee, and they roll it into the loan, because that's how they make their money, providing these VA loans. Some of the men and women who have actually gone through war or gone on tour and have gotten hurt and disabled, this funding fee is actually waived. It's a really good thing. So most loans, when you don't put any money down, they come with something called private mortgage insurance, which is actually an insurance that's put in place in case the mortgage is actually defaulted on and the consumer cannot make the mortgage payment. With VA loans, that private mortgage insurance, or otherwise known as PMI, it is waived. So it's another benefit for a veteran to get a great mortgage with putting no money down and have a very low mortgage payment. And another perk and benefit of a VA loan is the interest rates within itself are lower than an FHA loan or a conventional loan. So there's a lot of benefits that we're giving back to our servicemen and women. I particularly really love VA loans because I'm from a military family. My brother-in-law is a Chief Master Sergeant who just retired from the Air Force after 33 years. My best friend is a Lieutenant Colonel who just retired from the Pentagon after 20 years. And so being that this is really something that hits home, it's very easy for me to work with servicemen or women because I understand what they're going through. And then obviously it's been a big impact because, this is my family. I hear stories and I've seen things. So love VA loans. Number two, the FHA loan. Normally, a lot of people who go with FHA loans, you normally don't have the strongest credit score or a lot of money. Okay, not that's a bad thing because a lot of different things happen to people, but it's okay. But FHA loan is actually a tool for someone to still be able to purchase a home. So FHA, Federal Housing Authority, is a government-backed loan. And this loan requires what is called upfront mortgage insurance premium. So you don't have to have a very strong credit score. So what FHA does, they charge what is called a 1.75% upfront premium against the consumer. That's not something that they have to pay in closing costs when they actually close a loan. This is a fee that's rolled into the loan. Let me give you a quick example. If our consumer was getting a $100,000 mortgage and they use an FHA loan, when they receive the mortgage statement would show $101,750. So that 1.75% is multiplied against the loan amount and rolled into the mortgage. So this makes things a little bit easier. Being that the FHA loan does have some additional fees, some of the perks also that come with an FHA loan is the buyer or the consumer, they're going to get lower interest rates as well. Because with this product, you're taking on higher fees, but the way that FHA compensates and makes people feel better is they're going to be giving the lower interest rates as well. Okay, so an FHA loan is really a great loan. It's a great tool to have that bridge to get into the home. And the good thing is, you still can accomplish your dreams. It's a very easy loan to close, and there's not a lot of hassles with an FHA loan. When it comes down to a conventional loan, this truly is the best loan that a consumer can receive with the least amount of money and closing costs. What I also like about the conventional loan is that there's a lot of opportunity, not just to get a good rate, there's a lot of first-time home buyer programs. So right now it's a very, it's something that's really looked upon very strongly, because there's a lot of programs out there that are giving now up to $12,500 in grant money. So if you're a first-time home buyer, you have the ability to get, up to 3% of your down payment. You have the ability to get money towards closing costs. You're easily going to get, interest rates are going to be extremely competitive and low. Another great thing about conventional loans is there's no additional fees. Like with VA, as I covered, has something called the funding fee, and FHA has something called the upfront mortgage insurance premium. These two fees are actually rolled into the loan. When you're going with a conventional loan, there are no fees like that. There's nothing that has to be insured. There's nothing that has to be backed up or supported. So it really is a great loan. And then most of the people who actually take on conventional loans normally have credit scores of 680 and above, and they're going to be able to get some really great opportunities. What a conventional loan comes with is also called PMI if you're not going to put down 20%. Now, there is a rule that a lot of people used to think that PMI or private mortgage insurance is actually very expensive. There have been some changes in the market, which PMI, private mortgage insurance, now has been changed. So if you have decent credit and your overall debt leverages are low, based upon the area that you're going to be buying in and using a conventional loan, you're actually going to be receiving a very low private mortgage insurance payment. I just went ahead and quoted one out for one of my clients yesterday. They had a 790 credit score. They were purchasing a house at $510,000. They put down 5%, and their private mortgage insurance was only $88 a month. So when you're looking at the grand scheme of things, a lot of people are really worried about rates and mortgage payments and everything else. But at the end of the day, through transparency and education, when you're understanding the differences of these three loan products, we can really fit the box to customize a loan, particularly not only for you, but to make you very comfortable for the future, because you're getting the best loan that the market has to offer and that you actually chose yourself.
Yeah.
Great. That's great information, Mark. I do have one question for you. Are there special mortgage programs for our first responders or teachers?
Absolutely. There's a lot of grant programs that fall into those boxes. There's grant programs for teachers. There's grant programs for first-time responders. Don't get me wrong. We have a lot of tools and assets that we can provide as free and forgivable money for our clientele. But at the end of the day, they also have to qualify for it. It is important to have at least a decent credit score. It is important that some of these grant programs are capped by income. The logistics of it is far and wide. But, based upon the client and the clientele that we're working with and their expectations of what you're trying to obtain, I really am focused on seeing what I can do to always get people the best interest rate, the best program, the most amount of money and free and forgivable money, because I want them to show as a team, as a unified front, like, us three, that we're doing everything that we can for all our clients, because, buying a home is an experience. And we really want to make sure that we're giving them the best experience, not just for this one transaction, but a long-term relationship is what we're looking to buy. We want them to feel good that after, we close their loan, they're going to know that we're going to be there for them and support them in their corner and help them, their friends and their families. And if we're going outside the box through communications through us three, making sure that we can get these great programs for first-time home buyers or first-time responders or nurses or teachers, we really want to make sure that we're doing everything we can for everybody.
And Marc, I know that you do doctor loans. You also do jumbo loans. And then you also, let's see what other kind, and investment loans. So I think I trust Marc with all of our clients because he is so good at each finding the right loan for you. Because you might go in and say, oh, I'm going to do a conventional, but maybe something else, is better for you. So I really do appreciate that, the knowledge that Marc has. And he's great with jumbo loans, and those doctor loans are great too. And working with someone who has a lot of VA experience like Marc is amazing, because VA loans can be very tricky. And if you work with a lender who does not do a lot of them, they're not going to know how the process works. So that's why you get a great experience when you talk to Marc, because he's going to guide you just like we guide you in the right direction to find the house for you and the property. He's going to guide you financially in the right way. And Sue and I also say we never know what's going on behind the scenes. Marc doesn't give us anything about your financials. We don't care about your credit score. We don't ask about any of that information. We just ask Marc, what are they comfortable purchasing? And then we go from there. Right, Marc?
Absolutely. You've made a great point too, Mariella. When it comes down to the loan itself, we really want to understand what's best for the client. So when it comes down to physician's loans, when it comes down to jumbo loans, there is a lot of different unique guidelines. And I don't know if you guys have ever seen the movie The Matrix, how Neo, who is the one that sees the Matrix through computer code, I really take it upon myself that I can understand mortgages through a very creative perspective. And I want to make sure that we're always getting the best interest rate, the best program, the best opportunity. And you're absolutely right. I don't share private and personal information, but I am going to share the information that's going to allow us to be the most successful, especially when we're out looking for the buyer and we want to, they fall in a house that really fell on their heart. We want to put them in the best position possible so they can win. And through strategies and understanding about this client and where their needs are, this is going to give us the upper edge. One thing I take a lot of pride on is there is a standard in this industry called a pre-approval, which is just a preliminary piece of paper saying, I think I can give you a loan. As a lender, as a mortgage advisor who's literally helped thousands of families become homeowners, I don't have the ability to say that you will receive a loan. I have the skill set and the education and the information in front of me that it looks like I can give you a loan, but I don't like to give out preliminary pieces of paper to say that we're going to go ahead and provide this loan, because when you're talking about people, we're also dealing with real money. And, when you're going into a binding agreement, we have set contingencies that money is going to have to be provided pretty quickly from like an inspection or appraisal or earnest money. So what I like to do, and I've been very fortunate because I do close a large volume of loans, I have my own underwriter that works for me. So when I get to the point that I can actually provide the pre-approval, I send the loan over to my underwriter and they go through 95% of the loan up front, which is the work history, their income, their cash resources, and overall what the reserves are. And once that's said and done, within the same time that I can give that quote unquote pre-approval, I'm getting a full loan guarantee from my underwriter, which really puts us in the best place possible, because now we can guarantee that the folks that we're working with are going to be receiving keys in their hand. And what's also beneficial about having your own underwriter, all of the nightmares and frustrations that everybody might hear about this industry, we clear all of that up front.
Yes.
We have to jump over. We don't have to worry about anything like that. Literally when you're at this point of loan approval, we're going to need just an appraisal to make sure that the house that they're buying is at that value, and a clear title, and we can literally close as quick as 7 days. Where I love the fact of when you have a loan approval, if you have that property that someone really, really, really loves, and there's a lot of interest in that property, and we know there might be 4 or 5 or 6 offers, and sometimes that does happen, those other offers are just preliminary pieces of paper, letting the listing agent and seller know that I think I can go ahead and get these folks loans. And here you come with Mary Ellen, myself, and Susan with a full loan guarantee. It just sets the tone differently. You know, the seller knows 100% that they got the buyer that they want to work with. We just need to work out the dynamics. Obviously, that's your responsibility. And then once we do that, we're going to be smooth sailing. So at that point right there, you don't have to worry about your loan anymore because we've already taken care of that logistics part of it. And now all you got to do is just focus on your family. What's going to go into what box? What are you going to do for set up for moving? And, you know, the easy stuff, because we got you covered already on the loan side, which is awesome to be.
Yeah, and we
That's
love
great,
that.
Marc.
And I have to say, when you're competing in multiple offers and you have that loan guarantee, it's amazing. And it's one of our strategies that we really help our buyers get that great property when there's multiple offers, right, Sue?
Right. So, Marc, let's start from the beginning here. We have a buyer, we introduce them to you. What types of information do you need from them to get this into underwriting and to get the whole process started?
So that's a great question, Sue. I really want to know who the buyer is. I like to jump on Zoom calls with all the buyers I talk to because, you know, anybody can be a voice. And I think when you jump on a Zoom call, you make it a lot more personal. You can put a face behind the voice and they start understanding the characteristics of who you are. You're not just another person who's giving a mortgage, or you're just not just another real estate agent. You know, it's about personal experience and building the relationship, because at the end of the day, this takes care of our families as well. So when we go into it and I'm talking to a buyer, I'm understanding a little bit about them, you know, and one thing that I take a lot of pride in is I wear my emotions on my sleeves. And I want them to know that I'm a father, that I'm a son, I'm a best friend, you know, I'm just like them. I just have a different title, and we're going to figure this out ourselves, because it's important to bring down that guard, because we're not trying to sell anybody. We're trying to understand and provide to make sure that we can give the best support possible. So when I'm talking to these clients, you know, I'm just understanding who they are. Are they 1099 employees? Are they a W-2 employees? What did their background look like? You know, what type of money they have in the bank? I try not to get too heavy into that conversation up front, because, you know, we're just taking the baby step forward. So I try to keep it very light and easy. And then the loan process itself, after I gathered up some of the intel, I always want to protect people's credit first. You know, nowadays Equifax sells information for us as consumers all the time. So people get solicitation calls all the time. They're going to get junk mail, electronic spam, and everything. So the first step that I have for our clients is I like them to go to this website, which I already have highlighted on the email. I keep everything very easy and turnkey, you know, keep it simple. That's what I like to do. Always keep it simple. So I send them to a website called optoutprescreen.com so they can remove themselves of all these calling lists for the next 5 years. That way their credit is protected when I pull it, and they don't have to be bothered by getting 1,000 phone calls and who knows what's going to come through email and mail. Number two, after I've gotten the information of who they are, I just try to simplify it. I ask them for their driver's license. I ask them for their pay stubs, their bank statements, their W-2s. And if they are a 1099 employee, I'll ask them for their tax returns. I keep it super, super simple. When that's all said and done, to actually provide a mortgage, we look at the last 2 years of their work, their income, and their living situation. We do a 2-year look back. This is called the mortgage application. You know, I ask my clients, just do the best you can. You know, don't worry about it. Don't get overwhelmed, because it's not set it and be done with it. I'm going to scrub through the whole application as it is. And my goal is to make sure that all our clients are going to look like they walk on water and glow by the time they're done. You know, I want to make sure that this is going to be so easy. So when they do hit submit and my program reverts them back to their homepage, they're going to be able to upload all their personal documents in a web portal that's already password and security and firewall protected. Then now my team's going to be able to jump onto it. We'll get it all organized. And once I actually get through that call and I set everything up for success, that's when we're going to start getting into a little bit more of the logistics about the loan costs, the programs, where the comfort levels are. And then I'll be able to share, you know, once we get that loan approval from all those dynamics, then I'm going to be able to share that information with both of you ladies so we can really be, you know, on the forefront to make sure that we're finding that house, which is that perfect niche and payment for our clients.
That's great information, Marc. We appreciate that. And the process with AmerisBank is always super smooth. You guys are always right on top of everything. And we always encourage our buyers to gather their information together and upload it at one time and send things to you as a complete package rather than sending things to you piecemeal. But one of the questions we often get from our buyers is, okay, I've got X percentage of money that I'm putting down, but what are my closing costs and fees going to be for my purchase? Like, how do I calculate that at a very high level so that I make sure that I have enough money saved to go to closing?
So, Sue, that's a great question. First and foremost, I always like to understand about the buyer so I know what their down payment is going to be. If they are a first-time buyer and we cannot provide them a grant, their minimum down payment is going to be 3%. If they've been a homeowner before and they're trying to buy again because they just sold their house or in the process of selling, their down payment's now going to be 5%. When it comes down to fees in the state of Georgia, there are three main fees that everybody is responsible for. Number one is going to be the lender cost, which is going to be to my company to process, underwrite, and administer the loan paperwork to the real estate attorney's office. The second fee is going to be to the real estate attorney. Their job is to make sure that they're out of harm's way. So I always relate buying a home to like buying a car. You can't buy a car with a bad title, so you can't own a home with a bad title. So the job of the real estate attorney is to make sure that they're providing an examination from the day that that house is built all the way to the day that they're going to close it. And then upon that information, they're going to put together protection letters, they're going to issue title binders, they're going to insure it, and they're going to make sure that all the paperwork. So the second fee is always going to be to the real estate attorney. The third fee that the buyer is going to take on is just like you can't buy a piece of gum without paying any type of state tax fees in convenience stores. The same thing happens when you're actually buying a home. You're going to have transfer taxes, you're going to have state tax stamps that you're going to have to pay. So when you're combining these fees together, to give you a rough idea, you're probably going to be looking at anywhere from, I'd probably say 1.5% to 2% of the purchase price. It doesn't always necessarily fall in that range. So I don't want people to start thinking, okay, I'm seeing a $500,000 house, I'm going to have to pay $10,000. Everything is a little bit different because when it comes down to it, it's like where the house is located, the county is going to be, important. It's going to be the real estate attorney, what type of fees that they're going to be charging, the transfer taxes. So all of that does come together. And I do a really great job is that when we do get to the loan approval, I love sharing worksheets and educating people because living in the world of surprise is never fun. So we'll definitely go through all of the closing costs of exactly what they're going to need. And then the other fees that are going to come into play, which we call are the other responsibilities. We also call them the other costs. So when you do buy a home, just like buying a car, you can't drive a car without insurance. So you do have to take on homeowners insurance. Another thing is we have to create an account called an escrow account. Escrow is just a fancy name of a bank account that we put on your behalf in play that collects property taxes and homeowners insurance. So when these fees are due, most of the time property taxes are due in October. And then depending upon when when the buyer actually closes on the property that month, year after year after year, that homeowners insurance is going to be due as well. So I go over those fees as well. Now, there's a couple different ways that we can go ahead and obviously work on the costs so they can be a little bit more efficient and effective for people in terms of going into a home. But the most important thing is transparency. So when you're getting into a home, instead of letting people just kind of have their mind wander and be like, man, I can't afford this, it's going to be very expensive. It really is about starting off from the discover mode first to figure out what the reality is. Pulling credit for a mortgage is a need, not a want. You're not going to have any negative impact. People are so scared to pull the credit nowadays. There's nothing to be scared about. Like if you're going for a credit card or a car note or a student loan or installment loan, the way that those credits are actually analyzed, those are wants. That's going to be negative on your credit report. If you're going to buy a home, which is your primary investment, it's a huge investment. It's going to be the biggest debt that you can possibly have. There's not going to be anything negative about it. So just again, really going through every single step of the way, making sure that people are understanding exactly what you're doing, how the fees work out, what the interest rates are, what the bottom line is going to be. These are all attributes that I like to put into play to make sure that the experience that we provide everybody is going to be amazing.
That's
Man,
great.
Mark, you are so detailed and you just like answer our questions. And it's just like, it's amazing because you do need someone who explains the process, is detailed orientated, and is going to get you to that closing table.
Right.
And you and your team are just great with that. And I think you definitely have explained it in a way that we can't explain it, and you just explain it and it's, it's great. Right, Sue?
Oh, absolutely. I can't even tell you how many times going forward in the future, I'm going to refer this particular podcast to my buyers for them to listen to it, as part of, even our buyer consultation. It's something that I'm going to recommend that they listen to in the future. So I know today is August 21st, 2024. This podcast is going to be out there, hopefully, for years to come. But tell us a little bit about where current interest rates are, where you think they're going, and also about how somebody can lock a rate in and what the timetable is for that.
Okay, great question, Sue. Today's interest rates are actually starting to come down. There's been some movement in the market. Last week, we've actually seen rates come down about 3/8 of a point, which is great. And what we've been hearing now from the government is that rates could possibly go down again in September. Now, if the feds do lower rate, just for clarification, the feds lowering a rate is tied to the prime rate. The prime rate is applied to credit cards, car notes, and installment loans, student loans, home equity lines of credit. It is not tied to the primary housing rate. Those are two different rates. At times, the primary housing rate will trend down with the prime rate as the Fed's lower rate. It has happened in the past. But what does affect the primary housing rate to become lower is what's going on with the consumer price index, the inflation reports, the unemployment reports, job reports, what's happening with the election, what's going on with the world news. Those are pretty much the trends. And so where we are right now, rates are sitting somewhere in the high 5s to low 6s, depending upon the program that you're going with. If it's VA, FHA, or conventional, the rates are going to sway just a little bit different. Our clients are always going to have the opportunity to choose the rate that they want. It's not, here's me applying for a loan and here's your rate. That's not how it works. You always have a market rate, and you can always go ahead and have a lower rate if you choose to what is called you're buying down your rate. We just want to make sure if someone chooses to spend a little bit more money to buy the rate down, we want to look at that cost versus value, because people who are taking on mortgages right now, and everybody likes to see a low number on a piece of paper, it's really not the low number. It's about how you run your household. It's about the strategy that you want to go into with this home and how long you're going to be in this home, the time horizon that you're going to be in the home for. And we also want to understand that if we're going to go ahead and spend a lot of money for a lower interest rate, and the elections are right around the corner, and if rates do dip by the end of this year, if not the beginning of next year, we want to make sure we can capitalize that and not spend so much money up front. So we definitely go over all of that information with the clients so they really understand. I got a lot of great Excel spreadsheets and tools in amortization. I know that some of these terms could be a little foreign for folks, but after we actually get into calls, remember, I'm going to be in a Zoom call, a lot of people sharing information. I'm going to get them extremely comfortable that they're going to feel like they can do my job when it's all said and done. Okay, that's how thorough I'm going to be. When it comes down to locking an interest rate, that's also a great question, because until you go into a binding agreement, which means that the seller and the buyer have agreed and they have signed the contract, and now it's a binding contract, that is when you lock the rate in. Rate locks can last anywhere from 15 days, 30 days, 45 days, or 60 days. Those are the average terms of a rate lock. There are some situations when someone goes into new construction that if they want to take advantage of the rates of today, we have other options called rate lock protection or extended rate locks, where you can actually get a rate that can last 6 months, to a year, if not beyond. Now, there is a little bit of a more cost to it. We can obviously get in that conversation when it's time for that person, depending upon what they're going to buy. But a rate is locked in when you go into a binding agreement. Now, one question is always asked when I lock in an interest rate with my clients: what happens if the rate's lower before I close? Well, because that we have this rate lock protection within the final 10 days of closing. So if we were closing, let's just say on the 30th of the month, and we're on the 20th of the month, I'm watching the market like a hawk. And if the rates go ahead and they drop 3/8 or half a point, I'm going to be able to go ahead and modify or float down or convert. They all mean the same thing: modify, float down, or convert the interest rate to the best rate the market has to offer. So our client is going to walk away a hero, because it's not going to be a really good feeling when you're locked in, you have the interest rates that you want, you have the house that you want, you're super happy, and all of a sudden 5 or 10 days prior to closing, you see that rates just fell a half a point. It's really a pit in the stomach. And sometimes in the past, what has ended up happening is people would actually, basically start killing the deal because they're going to jump to some other lender so they can get a better interest rate. And it really caused a lot of disruption. It was really, really terrible. So more policies over time have gone ahead and been created. So if rates do come down, and we can see that we can swing them down like 3/8 or a point or maybe a half point, we do have the ability to go ahead and lower interest rate at no cost to the buyer. So they're winning across the board. They got the house, they got the program, they got the winning team of us three, and now they have the best rate the market has to offer. And I don't know how you can say happiness better than that.
You can't. You really can't.
You can't.
So my question to you is, we have there's always people out there listening to the media on the fence. They want to wait till the interest rates drop. And what we educate them on is that when the interest rates do drop, there's going to be more buyers in the market. So it's going to be more competitive, and you're going to have to pay more for a house. So what are you telling your clients right now that are kind of shopping or thinking about shopping?
I am telling them the time is now. Jump in now. And the reason being is because when the rates do drop and everybody thinks they want the lowest rate, they want the best rate. Don't get me wrong. It's great to have the lowest rate. It's great to have the best rate. But if you're buying now in a market that's not super, super competitive, I'm not saying there's not competition out there, but if you're buying now and you can get the house with a comfortable interest rate where you're at, that's what's important. Because, putting an offer in, going against 2 or 3 other families, and you're able to buy the house, that's a win for you. My company offers no cost refinances. So if you buy the house now and interest rates drop in 3 months, 6 months from today, now that you have the house, it's going to be very easy for me to go ahead and lower that interest rate at no cost for those clients. So it's a win-win. They got the house that they really love, and now they're going to be able to get the better interest rate. The folks that are sitting on the fence and waiting for these low rates, what's going to happen is going to be a feeding frenzy. Because as soon as the rates drop, everybody is going to jump in. You're going to see 10, 15, 20 plus cars waiting to get into this house to see this listing. And then when offers go in through desperation, people stop thinking. They get desperate, and the next thing you know, a house that could be going for 300, 400, 500, before you know it, they're putting offers in there 10, 20, 30, $40,000 over asking to go ahead and get this house. And what they're missing the point is all this money that they wanted to save in the beginning literally just went out the window because you got so desperate and you weren't thinking that you're pulling money out of all these different money market and certain accounts to get this house. It's not a good feeling. I have about 25 to 30% of my clients have called me back during over the years of when they purchased during the pandemic, and they acted too quickly because they felt so much pressure at that time because interest rates are so low and there were so many offers. They weren't really looking at the big picture, and they just had to react, and it really wasn't the best place, but they're stuck because they have that low 2 or that 3 and they feel they can't really go anywhere. That's not fair. That's not a very good feeling. You know, buying a home is something that should be really a great experience, not something that's going to add all this pressure and stress and you're losing sleep and all this other stuff. So if you jump into the market now and you're comfortable based upon the mortgage payment and your financial commitment, if you get some of these grants with free money and all these other opportunities that are literally there at your fingertips right now, think about it. You're not just getting your starter home, you can get something more of your forever home because you're jumping into a market that doesn't have a lot of competition. You know, some of these houses right now are sitting a little bit longer than expected. So the sellers are feeling some type of way. So you might be able to pick up a home at a discounted price that's going to be lower than the list price. And you wouldn't be surprised that some of these sellers will actually give you some closing costs to help you pay for buying their house. And I said that right. Sellers will actually contribute credit to help somebody buy their house. It's a very normal thing. So you find out, you know, jumping in now, you're going to really come out on top at the end of the day.
Yeah, Mark, let me ask you a question. You know, I know what the current interest rate environment is, but can you explain to some of our listeners when they should get a fixed rate mortgage versus an adjustable rate mortgage?
So that's a great question, Susan. I do not like adjustable rate mortgages, okay? And in the past, adjustable rate mortgages used to be a lower interest rate than the 30-year fixed mortgage because it's a riskier product. And anytime you add risk, you end up getting a lower interest rate, especially with ARMs, adjustable rate mortgages. The market now is really trending to security and fixed mortgages. So a 20-year mortgage is actually giving a great rate of return. The 30-year is really doing very well. These grant programs, they actually offer discounted interest rates. So today's conforming market rate, conventional loan, you're pretty much sitting around a 6.375 to a 6.49. If you are able to get a grant program, then you're going to be getting a discounted rate and you're going to be looking at an interest rate of like 5.875 to 5.99. So there's a lot of options and opportunity for the fixed rate positions. The folks that are going into the ARMs, you know, they're just putting themselves in a very susceptible position overall because it's not always just about the lower interest rate. And like I just mentioned, a lot of the ARM products are not really giving that better rate of return than the fixed rate. And that's more of a thing of the past.
So Mark, if we have a buyer that bought a year or so ago when rates were a little bit higher than they are today, how long or how much of a drop should rates take before they do a refinance?
That's a great question. You really want to see your rate of return to be at least 1% better. Okay. Now, I do offer no cost refinances. So what that means is if we have a loan of $500,000, by the time that I'm completing my refinance, your loan's still going to be $500,000. Okay. Other people say that they're going to be able to give you a no-cost refinance, but what they really mean is it's going to be no cost to you at closing. So what they're going to do is they're going to take the equity out of the home and they're going to roll in the closing costs. So instead of ending up in a $500,000 loan, you're going to have like a $510,000 loan. That's not a no-cost loan. So what I like to do is analyze the market, and when we see rates drop, I would call up my clients, since we do service the majority of all our loans and we make all the interest and we don't have to charge them transfer taxes and all these other frivolous fees. You know, I'm just basically breaking down the math to them. Here's what we can be. We can take down, you know, a point better. We can go a little bit lower than that, depending upon where we feel the rate market's going to be. But we definitely want to see a gain. That's what's important. We want to see a gain, which means that we want to see a lower interest rate. We want to see a lower mortgage payment. And my method to my madness is I like to inform folks that when we do refinance and you do have that lower interest and you do have that lower mortgage payment, keep making the same mortgage payment that you're making now. Because that additional amount of money is compounding against your loan balance, and you're actually going to pay your loan off quicker. So interest is really going to be a non-factor at the end of the day. So I have a lot of different strategies I create and I teach people. And since loans don't have any type of prepayment penalties nowadays or any type of balloon payments, that's a thing of the past called predatory lending. People can pay on the loan as often as they want, as aggressively, whenever they want to pay, as long as they make the mortgage payment. I have a lot of strategies for them to be debt-free very, very quickly.
That's awesome.
Good to know.
There are no prepayment penalties then, Mark, right?
There is not. Nope. Not at all. That's been gone for about 15 years, but people ask about it all the time. That's why when you look at loan documentation, like a loan estimate or a closing disclosure, they still have it as a loan feature. And once you see it, it says prepayment penalty and balloon payment. And underneath loan feature, it says no and no. So no more, and people are not going to get penalized if they come into a windfall of money or they want to pay off this debt a lot quicker. That was just all predatory lending back in the past. It was for the banks and it was never for the consumers. This is a consumer-based market now, and it has been for well over 10 years.
Yeah, we like that. We like consumer-based. We don't like that.
Absolutely.
Any other good questions, Sue, you got on your list?
I think Mark covered everything superbly today. Thank you so much, Mark, for all of your fantastic information. We appreciate working with you. You're phenomenal. You're the best that there is in the business. And we, just so appreciate the working relationship that we have with you and with our clients.
Yeah.
Well, I am very grateful and I'm very proud, in terms of relationships. We've been together for over 15 years.
Yes.
And I'm proud to say, Sue, you found my first home that I bought, which I still have now. So, history is everything. When you have the same morals and ethics and everything in line, this is what it's all about. And I think that's one of the reasons what makes us so successful as colleagues is because we're always in it for everybody. This helps our family. There's 5 families on every transaction. And when you have complete exposure and transparency, it just comes out on top that we always win. And, it's been an honor and a privilege for me to be with you ladies for so long. I'm looking forward to the future and what's to come, but I'm so grateful for the opportunity now and to be able to help so many people.
All right. Well, Mark, how does someone get in touch with you? Because I think that's important. Tell us.
Well, that's a great one. You can easily Google me, Marc Budnik. I also call myself the Mortgage Rhino because I consider myself extremely different than everybody else out there. But my number is really easy to remember. It's 404-354-1000. 404-354-1000. Very easy to remember. They can always reach out to you, of course, but if you just Google Marc Budnik or the Rhino, you should be able to see me all over. I'm on Zillow, I'm on Google. I have a whole bunch of reviews out there. And what's important too, if you are going to go ahead and look me up, read about me. I want you to understand I'm all about my faith, my family, my career. This is something that's not just a hobby for me. I really love to give and take care of others. And, that's one of the reasons why we align so much, Mary Ellen and Susan, is because we feel the same way. Mm-hmm. So, if you want to reach out to me, just look at Marc Budnik, the Mortgage Rhino, 404-354-1000.
Yeah, well, thank you so much for being on this great episode. We're the Real Estate Ladies of North Atlanta, Mary Ellen Vanaken, Susan Jennings, with our special great guest, Marc Budnik from AmerisBank, the Mortgage Rhino. So thank you for tuning in, and we will talk to you soon. Take care.
Terrific. Appreciate the opportunity. Looking forward to the future, okay? You guys be well and be blessed, all right?
Thank you.